Welcome to the Dry Club, where we attempt to put nuance back in the news. I'm Josh Bagley.
And I'm Brian Henderson.
And I'm Mario Mascaro.
So occasionally there's a story that pops up really quickly that we don't have the time to do our regular deep dive sort of format with before we need to bring information to you. So with that, we're doing a little mini series of shorts called Shots in theme with our Dry Club theme. So I know Mario and I both have shots. So when you're ready, Mario. God, I hate rum. All right, so today we're going to talk about GameStop, Robinhood, and the SEC's potential intervention in the whole ordeal. If you're not familiar with it, there's been a lot of hype around GameStop stock recently that's centered around a Reddit message board. So I very quickly want to sort of explain to you the mechanics of what's going on. So a large hedge fund attempted to do a short on GameStop's stock. A short is essentially when you borrow stock from a broker, you sell it at a price, and then you rebuy it at a much lower price, return it to the person you borrowed it from, and you pocket the difference between the high price you sold it at and the low price that you bought it back at. You pocket that difference. So if I borrowed a stock, sold it for $10, bought it back for $7, and gave it back to the organization I borrowed it from, I would pocket that $3 difference. And that's how hedge funds, traders, everyone else on the market makes money off of short selling. It's a relatively common thing. It's also not in and of itself illegal or wrong in any way. It's just sort of how it's another mechanism by which the market functions. So with that being said, a lot of hedge funds will stake themselves heavy in shorts with an attempt to drive down the price deliberately. And I'm going to throw this over to Mario to explain sort of how hedge funds do that.
So there's a very particular situation that took place in this instance, which is distinct from many other shorts, as Bagley was talking about. So what we see in previous instances is that you will have an organization of people who collaboratively participate in this short. So they will agree to try and short a particular stock or a particular commodity. And the intention is by the collaboration of selling simultaneously to affect the outcome which produces the value for them. So they will sell at the same time. That reduces the price of whether it's the commodity or the stock, and that allows them to buy it back. Now, that situation is under ordinary circumstances. In this particular instance, there was one key difference, which is that there was a Reddit forum which became aware of this collaborative short. And they saw that there was an attempt to drive the stock price down to a very low level where the price was below the value of the company. And having recognized this point, they then proceeded to buy this stock in high volumes and encourage others to buy stock in high volume. And what that did was it not only restored the original value, which had been lost as a process through the shorting, but in fact spiked the value of, in this case, GameStop, the company GameStop, GME, to an enormous high. I don't remember actually off the top of my head what the actual spike was. But the point is that all of these individuals essentially reverse the effect of the collaborative short that was affected to try and manipulate the market. As a consequence of this, the hedge funds, which have invested several billions of dollars in order to try and affect this scheme, lost their money, and even more significantly, lost their ability to gain that money back. And that has produced a very particular situation where the SEC has now begun to involve itself in this situation to try and determine what the regulatory framework should be and whether there should be any measures which might prevent this sort of situation from taking place again.
you might be wondering, how do you lose money on a short? And the answer is shorts are inherently time bound by a contract. So if I take out a stock at $10, or I take out a stock and sell it at $10, and then the price goes up to $15, I have to still buy all those stocks back at $15 on the contract's due date. So that's how a company would lose money on a short. And collectively, this hedge fund, what were they? Merlin Capital lost over the course of this short $23 billion and had to take an emergency liquidity injection from King Griffith and Citadel, as well as Stephen Cohen, who owns the Mets and a hedge fund of his own, I believe. So that's how you lose money in a short. And what's really important here is the mechanisms that have been put in place from that point to sort of limit traders' ability to trade as well. So a lot of the traders that use or that have participated in this spike use the Robinhood app and a couple of other small trading apps that are designed for people who want to sit on their couch and get interested in stocks. And today, Robinhood shut down the trading on for GameStop and AMC stocks specifically, because they were creating such volatility in the market. And a lot of people would argue that that's against the mission that Robinhood in particular has put forth as an investing platform. So I want to throw to both of you guys. What do you guys think about Robinhood clamping down on specifically being able to buy new shares in GameStop, on their app, given what their stated mission is?
So I'll jump in, obviously, because I love the sound of my own voice, and I'll obviously give Henderson an opportunity to respond after this.
Henderson,
I think
Jesus.
Part of the problem, I think, is that we have created a system where we have accepted when these kinds of circumstances have taken place in the past, because those who were advantaged by those events were the extraordinarily wealthy and the well-connected. And the difference in this situation is that the people who have gained by this set of circumstances, the individuals from Reddit and other places who participated in spiking the price of GameStop, are not politically connected. They are not, well-heeled Wall Street investors. They're just an enormous number of small investors doing so, behaving collaboratively to affect this outcome. And apparently that is not something that the SEC is willing to stand by and tolerate, even though very similar circumstances in the past have been tolerated when it has been to the benefit of those well-connected investors. So I think we need to keep that discrepancy in focus as we talk about this. At the same time, I'm in the very comfortable position of being able to rest on my own position in the past, which is to say, I am enormously in favor of more rather than less regulation. And this instance, as well as many others that we've seen in the past, right? The 2008, 2012, and many other instances of financial instability are genuine demonstrations that the kinds of exploitation done by the well-connected and the wealthy at the expense of the Main Street, as the expression is, are not to our advantage. They are extremely disadvantageous, not just for us as a collective, but globally. These kinds of issues have enormous ripples throughout the world, and there is no argument to be made that these kinds of outcomes should be permitted simply because it advantages, some particularly offensive Chad sitting in his Wall Street office.
So there's another piece of this too, right? And that's that this isn't a solo thing. And we talked about the shorts, but I want to talk about longs for a minute too, right? Because there are a number of companies whose value has been significantly inflated, similar to how GameStop's has been currently. And in that instance, it wasn't by rogue investors from Reddit. I mean, Uber is a great example. Uber is a company with no net assets that has never turned a profit and currently has a market cap, I believe, over $100 billion. And there are examples like this throughout the market. So
with no
profits. What's that?
With no profits. I have a dog downstairs that's never made any money, but yet is not worth $100 billion. And I find this extremely unfair.
So the larger point to this is that this is something that occurs, and I don't think it's fair for the SEC to attempt to investigate these smaller investors for doing what they did without also realizing that we have to hold more people accountable. And that does mean broader regulation in the long run, but it also means sort of rethinking how we trade. And I don't want to go too deep into the weeds with this because this is a whole video that I want to do sometime later. We have to change monetary policy drastically. And Mario's shaking his head. By monetary policy, we both mean interest rates. And we will do a video on that later, I promise, because this is something I will get deep into the weeds with. But in order to see the mechanisms of our markets change, we have to see a change in monetary policy. We've got to see a raise in interest rates, period.
So the purpose of this video is to talk really about the specific events that have occurred in connection to the stock of GameStop and others, and really to focus on that specific thing. We're not intended here to sit down and talk about these issues more broadly. Having said that, when we do get into these more substantive issues, the lens through which you should understand this is what is the impact of any particular set of regulation, any particular proposed regulation? Who does it advantage and who does it disadvantage? And the problem at present is that the system of regulation that existed during the events of this GameStop short and then spike, that system was designed to enable and advantage these massive multi-billion-dollar hedge funds to make money at the expense of the rest of us. And that is a really important thing that we need to keep in mind as we understand how the monetary policy should be crafted and who it is designed to affect.
All right. Well, Hendo, do you have anything that you want to add?
I was just hoping. Well, I was just thinking about the initial question. It was what we had both thought about Robinhood blocking all trade from. I think it was at least GameStop. I don't know if it was Blockbuster and what was it, AMC as well.
It was GameStop AMC that they blocked all trading from.
Okay. Yeah, I mean, my answer to that would be similar to, I think, what we were discussing on last week's episode. You know, I don't know if there would be any legal ramifications for Robinhood. I don't imagine that there would be, but I don't know. I guess they feel that is in their best interest to, to make money, I guess. I don't know.
This is a huge legal ramifications against Robinhood in this instance. There's been a class action lawsuit filed against them already because at this point,
of
Robinhood,
all of the
as a
Redditors.
Yeah. So the issue is that the decision to block trading on those particular stocks disadvantaged those individuals who were participating in trying to affect this outcome, trying to produce this spike. And that the effect was not ubiquitous in the sense that it did not affect those individuals who were trading through brokers or otherwise were buying those stocks, except through those specific applications. And so the issue is that this was a situation where there was an intervention which specifically and deliberately disadvantaged only a specific group of people.
Now, why is
to
that?
The advantage of others?
So there's also So
No, why did it only disadvantage the people using are going to use Robinhood
because the
for
hedge
example?
fund doesn't trade through I've suddenly forgotten through Robinhood, right?
Mm-hmm.
They are, in this instance, they are the prince. We'll have to cut this bit because I can't remember his name. The one that Robinhood stole from. But the issue is that that was a joke. Keep this bit in. But the shareholder,
Okay.
the hedge fund does not trade through Robinhood. Right?
Of course,
so
yeah.
they are able to continue to interact with the share, continue to try and salvage the enormous hole that they have dug for themselves without being influenced by these quote unquote low level traders who are interacting through the market through Robinhood.
Mm-hmm.
That's
there's
why
another
it's
piece of
created
it,
this
too,
disadvantage.
because Robinhood didn't completely shut those stocks off. They allowed traders who owned those stocks to only settle their positions. So the only thing traders could do was sell their current GameStop stock that they had. They couldn't buy additional, they could only sell, which obviously will drive down the price in an artificial sort of way. So honestly, in addition to the class action suit, I think GameStop has a manipulation suit that they could hand to Robinhood if they choose to as well, because Robinhood falsely manipulated the price of their stock in a very open way by only allowing their customers to sell that stock.
So this has already become a little more specialist than this video was intended to be. So I just want to post a specific challenge here. So the three of us are willing to respond to any question. So if at any point we have been unclear, I invite anyone who may have those questions to respond under the YouTube video, and we are more than happy to try and explain a specific point of nuance or clarify a point that we've made. We're more than happy to do that.
Yeah, you can hit us up on Facebook, as Mario already mentioned, YouTube. We're also on Twitter, Instagram, etc.
All right. Well, we appreciate your kind attention. Again, this has been Mario Mascaro.
Josh Bagley.
Brian Henderson. Hey, thanks for watching this video. We really appreciate it. And if you liked this video, please consider subscribing. You can also like the video and comment down below. We'll be sure to read them and reply to them. And, if you subscribe, I'll try and convince my co-hosts to grow mustaches just like me. Thank you.